Hey, so I think that there is a lot of misrepresentation about what indexed universal life is and what it's not. The pros of it, the cons of it. Is it a good, call it investment? Is it too expensive? I'm David Harter. I'm with Epic Financial Strategies, and I've been representing insurance for almost 23 years. And what I'm here today to do is to explain not only what indexed universal life is, but the pros of it, cons of it, but cons from the standpoint of representation of it being a byproduct of a future process. That's really what it comes down to. When it's built the right way and when it's put into the right portfolio for the right reasons, indexed universal life can be a fantastic vehicle. So what is indexed universal life insurance and how does it work? Well, first things first, you have to know that indexed universal life insurance is built on a universal life insurance chassis. Universal life insurance is a permanent life insurance vehicle. It is meant to be built so that at some point in the future, when you pass away, regardless of when that is, there will be a death benefit that is paid to a beneficiary. Now, at its crux, universal life insurance is built very precise. I pay a certain premium, I have a certain death benefit that's attached to it, and as long as I live, it is guaranteed to pay that death benefit. It really is not built to build a lot of extra bells and whistles, such as cash value inside of the policy. It's built more precisely than that. The combination of your contribution to it and some cash that is built into the policy that's credited at a current interest rate combines to make sure that the death benefit is going to be payable to your beneficiary in the future, whether it's for death or whether it's for mitigating estate taxes, whatever the case may be. There are added features that can be put onto universal life insurance policies, and that was really the birth of indexed universal life. What insurance companies wanted to create for people was the opportunity for the cash that was inside of these policies to accumulate so that it could be used for other things, potentially. It could be used as a retirement income supplement when you retire. It could be used theoretically to borrow against, to do certain things while you're in your working years. The concern of having money that's in a life insurance policy that doesn't really have guarantees attached to it is that, well, how is that money going to grow? Well, originally, variable universal life came out. What variable universal life is it gives you the opportunity to take the cash that's in the insurance policy and choose different what's called accumulation units. They're very similar to mutual funds. Essentially what it did was it shifted the risk of guaranteed growth from the insurer over to the insured, the policy owner, right? So they're going to shift the risk to you. If you want the cash to grow, that's fantastic, but you're going to have the choice and the onus is on you for how that money is going to grow. So you're going to have to choose different accumulation units in there. If they weren't built the right way, and if I made bad choices with the accumulation units that I invested into, there was a risk of loss. When a policy doesn't have enough cash inside of it and I lose value because the market drops or I made, call it less than optimal investment choices, not only has my cash dropped, but theoretically I might owe more money to the insurance policy because remember, it's a life insurance policy. It was built on that universal life insurance chassis. So a certain amount needed to go to it from contribution and the cash needed to grow at a certain rate to support the death benefit. Well, if that cash dropped, I might be stuck and on the hook to have to add more money to it. So what was the go-between? That's where indexed universal life insurance was formatted. What it gave people was the opportunity to have some skin in the game for growth of the cash, but with, call it safety nets. I like to call it boeing with bumpers. So the way that indexed universal life insurance is built is with derivatives and different complex style investment strategies that the insurance companies put in place so that when you put money into the policy while supporting the death benefit, the money that goes into the cash inside the policy can be benchmarked to grow with a benchmark. It could be the S&P 500, it could be a custom index, but the growth of the cash is benchmarked to that index. So if that index grows in value, your cash participates with that growth and mimics that growth. The insurance companies use specific strategies for hedging. Now, what does that mean? What that means is that through derivatives and through investment strategy, they can create certain guarantees on these policies. They can create what's called a floor. So if you ever seen a little kid that bowls with bumpers, the reason that they're bowling with bumpers is not because they want a strike every single time, but they want the ball to be bouncing off the gutter to ensure that it hits one pin. Well, IUL is not really that much different. The insurance companies use these strategies so that if that index that your cash is benchmarked to drops in value, which does happen, obviously, markets drop, they can guarantee that you have a floor. That floor has been 1% at times, that floor might be 0, but theoretically they're hedging and ensuring that the cash that's in there won't go below 0. Basically will stay flatlined. Now on the flip side to that, as the benchmark appreciates, your money participates with that benchmark, but there's a catch. They also put a ceiling or a cap on the growth because they can't overexpose themselves too much, right? They have to hedge, as I had mentioned. So if you're benchmarked to the S&P 500 and the S&P 500 does 50%, your participation will be capped at a specific rate, and it depends on the insurance company. But that's what I mean by bowling with bumpers. It keeps your cash in line in between the floor and the cap. There's also flexibility in funding on indexed universal life insurance. Remember when I was saying that it's built on the universal life insurance chassis, and so there is a targeted premium that is supporting a death benefit. But the targeted premium is kind of like the floor. There is an extra amount or overfunding that can be done into these policies up until a spot where there's too much cash in the policy and it becomes something called a modified endowment contract, which is a different conversation for a different day. Essentially, inflating a balloon and getting as much cash into the policy before it pops and becomes taxable. But the insurance companies allow you to overfund above the targeted premium up to that limit, and they alert you when that limit is. Why is that so critical? Well, you've heard of things like dollar cost averaging into the market when you're investing in your 401k or a brokerage account. And essentially, mathematically, that works because markets move up and down, and you might buy more shares at cheaper prices so that as it grows, you have more wealth. Well, Index Universal Life kind of provides that same bumper from the standpoint if I'm overfunding it and the market drops down, then as a result of the amount of additional cash that went in, I'm not going to be on the hook later to have to put more money into it because I overfunded and overfunded and overfunded, and when the benchmark recovered, I grew more wealth. Over multiple market cycles, the S&P 500, the markets have historically provided really, really nice growth. But you have to be strategic with when you're positioning, when you're thinking about an indexed universal life. Am I going to use it as a bank on myself concept? That's debatable because of the fluctuation of markets. Remember, that money is tied to markets. And if I need that guaranteed to me 2 or 3 years down the line, because I'm going to use it to make an investment, I don't know if that's necessarily the right fit. We would have to have a conversation about that. But if I'm thinking about long-term, multiple market cycle, retirement distribution on a tax-free basis, Index Universal Life Insurance can certainly have a complementary fit into a well-designed insurance portfolio. What we must do is we must look at and benchmark your beach house. We have to benchmark your goals. Everything is based upon process. System, process, system, process. If your money is benchmarked for something far in the future and you're not taking IUL or Index Universal Life into consideration, you're missing the boat, in my opinion. We should sit down and have a conversation about that. If your goals are based upon short term, that's one thing. If they're based upon long term, it's another thing. Through diligent process, The byproduct of that process can be something that includes Indexed Universal Life in your world. If you'd like to have an audit of your insurance portfolio, if you'd like to have a conversation about, is it a good fit in my world? If you'd like to have a conversation just to get deeper about how it actually works, click the button below. We'll set up a conversation where we can talk through your goals, your objectives, and does Indexed Universal Life fit in your world?